Welcome to this Business Tax Roundup for this month. My name is Dean Wootten. Initially, we're going to look at the announcement that MTD for income tax has been delayed. No surprise really, but it's been put back 2 years. So from April 26 was originally going to be April 24. So from April 26, businesses, self-employed individuals and landlords were required to report via MTD for income tax purposes if their turnover exceeds 50,000. If you remember, that was originally supposed to be 10,000, so that's changed. Now, from April 27, those with turnover of over 30,000 will then be required to join the scheme. So there's two changes really. One, MTD has been deferred by 2 years, and they've increased the turnover limit. So that will drop a lot of people out of the MTD reporting net. Now, the government have also announced that they'll review the needs of smaller businesses, particularly those under £30,000. That's turnover. Date for partnerships joining MTD for income tax is yet to be announced, and no comments on MTD for corporate tax. Yeah, when you start to look at this, you wonder if it'll ever come in. But at the moment, deferral till April 26 for income tax, partnerships not mentioned, corporation tax not mentioned. The new penalty system bringing late submission and payment penalties into line with VAT, and that's the change coming in from January 23 for VAT purposes, the replacement for the default surcharge. That's going to come into effect for income tax purposes when MTD for income tax comes in, which is obviously a lot later now, April 26. There will be a new penalty system for income tax self-assessment taxpayers outside the scope of MTD, after its introduction for MTD taxpayers, but that is way down the line, so we'll wait and see on that one. Now, many of you would have had queries from clients regarding this next point. Now, HMRC have found discrepancies between information contained within the corporation tax returns and the amounts appearing in the tax computations. There seems to be a breakdown of communication, really, and not really communicated to accountants as to what should go on the tax returns when we look at the corporation tax computations in some cases. Now, when the corporation tax loss reform rules were introduced on the 1st of April 17, the treatment of brought forward losses changed. In some instances, they found that one or more boxes on the CT600 have included brought forward amounts, and that is not in line with those rules. The boxes in question relate to property losses, non-trading losses on intangible fixed assets, and management expenses. So not all of you would have had these queries, but particularly if you've got property companies with property losses, then you would have had something coming from HMRC on this. They've written to companies and their agents to make them aware of that issue. You haven't got to do anything, because what they're going to do is they're going to ignore the CT600s and rely on the tax computations to correct the position. So no action is required from companies unless you disagree with their approach. But it's more of just a reporting issue, really. The losses per the tax computations is what they're looking at. So therefore, we don't really need to do anything about this. Let's look at quite an important capital allowance case from a practical perspective. Now, the Capital Allowances Act 2001 has some key section numbers in it. Obviously, all section numbers are relevant, but for practitioners, there's a few that are particularly relevant. And now it's Section 21 to Section 23 of the Capital Allowances Act, and it's something that we should all be aware of when claiming capital allowances. Now, Section 21 is headed up buildings. Now, that details categories of spend that do not qualify as plant and machinery. And in that Section 21, you've got things like walls, floors, ceilings, doors, etc. Stuff that you wouldn't normally expect, anyway, to have as capital allowances. Section 22 has a heading Structures, Assets and Works, and that also deals or details a category of spend that doesn't qualify for capital allowances. And it's stuff that, again, we wouldn't really expect capital allowances on. It's tunnels, bridges, etc. When I say capital allowances, it's more qualifying as plant and machinery allowances. They may obviously get the structures and buildings allowance now, but they won't be regarded as plant and machinery. Now, the key one really is Section 23. Now, Section 23 details expenditure that does qualify as plant and machinery. And it's got some specific cross-referrals to other section numbers, like section 33 for personal security, section 33A for integral features, and they've got this list C. List C has been built up over many years, partly by way of case law, which is now embedded in legislation at List C. And that List C is quite comprehensive. It's a list of items which do qualify for capital allowances, and that List C is very important for practitioners. Now, List C is essentially a list of 33 areas of spend, with each area having multiple items. So I'll give you a few examples from that list. Item 4 specifically states manufacturing or processing equipment, storage equipment, including cold rooms, display equipment, and counters, checkouts, and similar equipment. Item 5, cookers, washing machines, dishwashers, refrigerators, and similar equipment, wash basins, sinks, baths, showers, sanitary ware, and similar equipment, and furniture and furnishings. Just as a note on that, obviously we don't claim those in residential buy-to-lets because there's a specific provision which precludes those claimed in residential buy-to-lets. But generally, if you're a normal trader, hotel for example, then you'll be looking at capital allowances on item 5. We've also got item 4, decorative assets provided for the enjoyment of the public in hotel, restaurant or similar trades. That might be when you're trying to create a certain ambience, and the decorative assets you buy would qualify for capital allowances, plant and machinery. And with a £1 million annual investment allowance, that will also be a full deduction. Now, when you go further down the list, let's start at item 23, you start to see the phrase, the provision of. And item 23 is the provision of dry docks. Item 28, the provision of silos for temporary storage or storage tanks. But the provision is in every single item from item 23, but it's in none of them prior to item 23. So let's focus on that phrase, the provision. Now, these words imply that ancillary costs of ensuring the items within 23 to 33 can be safely used on the site would also qualify for capital allowances. For example, transport and installation costs. Whereas items 1 to 22 would just cover spend on the item itself. That is a natural thought process because why has 23 onwards got the provision of, and why has 1 to 22 not got that? So is there a differentiation or difference between 1 to 22 and 23 to 33? Now, a recent case, Urenco Chem Plants Limited, the taxpayer, amongst other things, was arguing that there should be no such distinction. And the Court of Appeal agreed. They said this is a drafting error. And the Court of Appeal said that expenditure on all List C assets should be read as meaning expenditure on the provision of such assets. So even though the provision of is not within 1 to 22, the Court of Appeal thought that was just a drafting error, and it was the intention that all List C assets should include ancillary costs of ensuring that all items within List C can be safely used on site, would qualify for capital allowances. Now, other elements of the case disputed which spend fell within Section 21 buildings and which spend fell within Section 23 plant, but it's very specific to this particular case. And there was significant spend falling within Section 21 as part of the setting in which the business was carried out. Now, these days, that spend should qualify for structure and buildings allowance. So that should be okay. You're not going to get relief, obviously, as quickly, but you will get relief for building spend these days. But there is this distinction between, is it part of the setting or is it part of the function? And if you're looking at a client with that dilemma, then it's quite a useful case to look at this Urenco Chem Plants. I guess the wider point is that List C is in the provision of, and that's 1 down to 33. So that's quite an important point coming out of it. And the other is looking at when it's a building, when it's not a building, and what are the essential characteristics of a building. There was quite a bit of detail in this case on that. We'll now have a look at an investment company and the deductibility of management expenses. Now, this is a recap, and management expenses are deductible against the total profits of a company with investment business. Now, the deduction is based on when the costs are debited in the GAAP compliant accounts of the business. So it's on an accounts deductible basis. Now, no expenses can be deductible as management expenses if they are deductible elsewhere. Management expenses are effectively like a catch-all, a backstop for stuff that doesn't get deducted elsewhere. Now, expenses of a capital nature are not deductible as management expenses per Corporation Tax Act 2009, Section 1219, subparagraph 3. Although they may qualify for capital allowances, they won't be deductible as management expenses. The reason behind this is what these management expenses essentially do is put investment companies on the same footings as trading companies. Trading companies deduct when incurring revenue-based costs on a wholly and exclusive basis. So that's the idea behind management expenses deductions. They've obviously not got a trade, so therefore wholly exclusively on the trade doesn't work for investment companies. So therefore they just have these management expenses which are deductible generally unless they are capital. And if they're capital, they're not deductible. In this particular case, Centrica Overseas Holdings Limited, they're an investment holding company with a Dutch subsidiary, Oxio. In 2009, the group decided to sell Oxio, and they achieved a part sale in 2011 via partial demerger. I don't think that's that important. What's important is what they're trying to claim as a deduction against that transaction. Now, between these dates, the group incurred fees totalling 3.8 million, and they were recharged to the holding company, and the holding company claimed 2.5 million as deductible management expenses. HMRC refused the claim. They said that the costs relate to a different company, so not the holding co, and they'd related to a decision taken by a different company. Now, this case went through the first tier tribunal, the upper tribunal. It went to the Court of Appeal, and the Court of Appeal decided they had two questions to consider. Were these costs management expenses of the holding company? And if they were those costs of a capital nature? Now, the Court of Appeal found that the first tier had correctly directed itself as to legal principles and applied them to the facts. The first tier were entitled to reach the decision that the disputed costs were management expenses. So they were management expenses in the Court of Appeal's eyes as well. They then went on to the second question. Were they revenue or capital in nature? And remember, if they're capital, they're not deductible. Now, Section 12193 was intended to exclude capital spend. And the Court of Appeal said you should look at that in line with case law on revenue versus capital on trading expenses, because that's obviously we've got a lot more of those to consider. Now, in the Court of Appeal's mind, when they looked at the case law on trading expenses, revenue v capital, they thought, well, the purpose of this spend was to decide how to dispose of Oxio. The decision to dispose of it had been made. This was all about how to dispose of it. Now, in their mind, the disputed expenditure was within the exception in 12193A. Therefore, they were capital and they were not deductible. I would say that costs incurred in determining whether to sell should still be deductible. This decision is looking at a point where we've decided to sell. How do we do that? And in the Court of Appeal's mind, they say, well, that's capital, and therefore that's not a management expense deduction. Let's move on to some VAT. This one we've got Ashton's Legal, and they're a partnership. Now, this partnership was registered for VAT, and it was looking for alternative premise. It did find suitable premise, and negotiations were carried out by and on behalf of the partnership. It was the partnership that signs the heads of terms. But Land and Property Act only allows a partnership to enter into a lease in the name of up to 4 partners. This partnership had more than that. The lease was therefore agreed with Ashton's Legal Limited, a dormant shell company that was acting as the partnership's nominee. Now, landlord understood that the partnership would be the sole occupants and would pay the rent. But it was just a formality, really, that under the terms of the lease, the rental invoices were addressed to the limited company, but they were sent directly to the partnership for payment. The invoices were processed, paid, and input VAT was recovered on the partnership VAT return. Now you kind of see HMRC's interest in this because as far as they're concerned, they've got invoices addressed to a limited company, which are deducted in a partnership, and HMRC didn't feel that was appropriate. So HMRC denied the input VAT claim, arguing that the supply was made to the company, and there was a second supply of equal value made by the company to the partnership. And as the company hadn't opted, that was an exempt supply. And as it was an exempt supply, the company couldn't recover the VAT on the rent that it had paid. Now, partnership appealed, arguing the commercial point was there's one lease between the landlord and the partnership. The company's involvement was only there because of the Property Act restrictions. Now, first look at this now. So, we've got to look at the economic and commercial reality of the deal. The partnership used the premise. The partnership was liable to pay the rent as it fell due. Now, all parties knew that Ashton's was just a dormant company. It was a mere cipher inserted into the lease to deal with a property law issue. And when you look at cases like air tours, holiday transport, it supported the partnership's view. You've got to look at the commercial and economic reality. And that was that the partnership had received the supply of rent. They were entitled to a deduction for that. So the commercial and economic reality overrode the fact that there was this invoice in the company name. That company name, or the company, was just a mere nominee, just for compliance purposes. It wasn't really, it was dormant. It didn't have anything there, apart from it had signed a lease. And that was it. We're now going to look at Apollinaire and an individual, Zakir Hussain Hashmi. Now, on the 6th of October 15, Apollinaire Limited was incorporated and registered for VAT from that date. The sole director and shareholder was Benny Hashmi, who had a history of setting up companies, not a very good history, unfortunately. The companies he set up were essentially Phoenix companies. They were set up, traded for a bit, shut down, owing money. So, and he had a regular history of this. Now, one of those companies was Snow White Limited, traded as Benny Hamish, but referred to as Snow. That was incorporated in November 10. The trade was supposedly sold to Mr. Singh, although there was some doubt over that point. Following that, there was VAT deregistration. Snow ceased trading at the end of September 15, dissolved August 16. Now, HMRC's RTI information showed that until September 15, the end of September 15, Snow had 6 full-time employees, including Benny Hashmi. On the 1st of October 15, all six individuals commenced employment with Apollinaire Limited. Apollinaire started trading under the name of Benny Hamish. The company operated from the same premises as Snow. Now, Apollinaire submitted its first VAT return covering the period 6th of October 15 to January 16 with a thumping great repayment, £98,000, and that came mainly due to input tax claimed on stock bought from Snow. Now, HMRC believed there had been a TOGC from Snow to Apollinaire, and therefore input tax wasn't claimable because it had been improperly charged. Now, with Benny Hashmi's history, HMRC issued a penalty liability notice for the penalties. The penalties were between £50,000 and £60,000, as HMRC believed the errors in the return were deliberate, i.e. in Apollinaire's return were deliberate, and there was a risk that the company one day would become insolvent. Now, Apollinaire appealed to the first tier tribunal. Now, first tier thought that Benny Hashmi's evidence lacked credibility. They questioned whether this chap, Mr. Singh, ever existed. As far as they were concerned, there was a transfer of business going concern between Snow and Apollinaire Limited. Benny Hashmi was director, shadow director, controlled both companies. The trade before and after Snow ceased trading was unchanged, had the same trading name, the same employees, the same premise, everything was the same. So therefore, that was a TOGC. So therefore, no input tax was recoverable on the stock transferred as it had been improperly charged, and the appeal was therefore dismissed. The TOGC rules are mandatory, and when a trade is transferred between two registered parties, it is an outside the scope transaction. And you can see HMRC's concern here because they were very much aware or concerned that output tax would be charged by the Phoenix company, for example, and then the new company would recover it. And to them, that didn't quite seem right. And they said, well, it's a TAGC, so you can't recover the VAT. And the penalty liability notices also got charged on the individual. We'll now pick up one of many cases concerning subway franchises. And this is Neoteric Limited, UK Limited. And they operated a subway in Suffolk. HMRC were concerned the reported standard rate of sales were low. And obviously, in these types of businesses, you've got a mixture of standard rated and zero rated. And they were concerned the standard rated sales were low. And they were being shown around about 55 and 78% of total sales. So much lower than the expected average of 87%. And that's quite important information there, because if you do that for a subway franchise, then we could check ourselves what they're declaring, because HMRC expects the mix of standard versus zero to be 87% standard and the balance being zero. Now in August 17 they carried out 2 test purchases. Standard rated food they found was being shown as zero rated. 2 further investigations revealed the percentage to be 88.97, the correct percentage to be 88.97 and 93.3. So the client had been under declaring over the years. Now the company provided no evidence to the contrary. So HMRC issued a best judgment assessment for £45,000 for the period January 14 through to July 17. Now Neoteric appealed, and they argued the assessment had not been made to HMRC's best judgment. Now the courts looked at this and they said, well, the officers had a duty to use only the material available to them and to calculate the tax underpaid with an honest and bona fide approach. HMRC had done everything expected. They used evidence from their 4 separate visits. And they combine this with their experience of other subway franchises. They've also got to flex it. I mean, if they go along on the busiest days, then they've got to flex the fact that it's a busy day, and also the fact that if they go along on a particularly warm day or cold day or a particular season, the mix of sales might well be different to the norm. But they're experienced in subway franchises, so they should be doing that and flexing the assessment, which they did. Now, Neoteric had not provided any alternative calculations or evidence. And as a result of that, the appeal was dismissed. You can't just say, oh, they haven't done it to the best of the judgment. You've got to prove why you think they haven't. And if you don't provide any evidence to suggest why that's not right, and one would hazard again and say, well, probably because HMRC were probably near enough on the mark. But you've got to provide evidence. And if you don't, then the courts are not going to rule any other way but in HMRC's favour. Well, that concludes the Business Tax Roundup for this month. My name's Dean Wootten. Thank you for listening.